Hello and welcome to this webinar on absolute basics of options trading by Sensible. If you guys belong to some of our experienced crowd, I would say that this is not for you. This is for absolute beginners to look at options and understand them from a way which is very novel so that you get a very intuitive understanding of options. What we will not learn in this webinar is, I've been trying to teach options for quite a bit, and options have been traditionally taught by people as right to buy, obligation to sell. It is Greeks and I don't know what else. It's all confusing stuff. We will not do any of that today. We will look at options from a concept which everyone in this webinar understands, and this is about looking at options the way they have to be looked at, which is as insurance contracts. So we will learn options as insurance contracts in this webinar, and that will completely change the way, if you're a beginner, that is the way you look at options. We'll look at what are call options, put options, how they work, etc. Very simple stuff, nothing majorly fancy. We will talk about buying options versus selling options, when to buy and when to sell. And we will also look at how option prices change. So the most important concept here is that options are insurance contracts. So you can see somebody is afraid, that is the option buyer. And then somebody looks like a very, sued salesman who's trying to make some money off you. That is the option seller. So option buyer is an insurance buyer. He's somebody who's afraid of something, who's trying to think of something improbable. And option seller is an insurance seller who's trying to make money by selling fear or love or greed to the option buyer. This is very elementary and important to understand. So when do you buy an insurance? You buy an insurance when you're afraid that price of something might change a lot. For example, when you have a health scare and you're wondering about, should I go to hospital? You are worried about, how much will my hospital bill be, right? So something which is very big, something which is going to change very huge, etc. In that case, you buy an insurance, right? Like, let's say, for example, a car accident insurance. You think that the workshop bill or your health bill will be a lot, so let me get some insurance. Similarly, options are also insurance contracts, and this is a small illustrations for that. There is somebody which is you, he's like wondering, what, I smoke a lot, so I'm afraid one day I'm going to get it. I mean, no moral high ground here, ex-smoker, so I'm going to incur a lot of money in bills if something happens to me. So then the LIC agent comes and says, give us 10,000 rupees every year and we'll take care of your hospital bill. This is a typical example of an option buying situation. You are the option buyer here because you are buying an option on your insurance, on your hospital bill, whereas this LIC agent is the option seller here. He's trying to sell you insurance on your hospital bill. So LIC agent is the option seller. You are the option buyer, right? So basically you give a very small amount to LIC. That is what is happening as an option buyer, and LIC will give you a large amount if something happens, right? Hopefully nothing will happen, but the more your hospital bill, the more money you get to pay those bills, correct? So let's put it this way. What is going on in LIC agent's mind and what is going on in your mind is something which we have to understand in order to understand how exactly options work. This is extremely important. See, the psychology of an option buyer and psychology of an option seller is something which you have to understand before you start this option trading business. So let's get inside the heads of both this LIC person and you, which is the option seller. So the LIC guy is thinking here, most probably he won't go to hospital. He's just worried because he has smoked like 5 a day, right? But okay, or let me put it this way. He and 10 of his friends are smokers. He might end up in a hospital, but not everybody is going to go in a hospital. This is the idea of probability, right? Like LIC is happy selling you insurance contracts at 10,000 rupees a year because they know 1 or 2 of us can go up, but not all of us can go up together, correct? So if an LIC agent sells a lot of policy, or if LIC sells a lot of policies, over all of them, LIC will make money. And there is a small chance that LIC will lose a lot of money, but then who cares? There's a small chance. What are you as an option buyer doing here? You're thinking, most probably I won't go to the hospital. That even you know, right? Most probably nothing is going to happen because of smoking. Like, okay, smoking is a wrong example. It's a bad habit. Let's just say something else. I don't know. Like accident insurance, car accident insurance, let's say. So why do you, but then the problem is, right? You know, okay, this is a small probability, but this is not a chance you want to take in life. That if, let's say, a car accident or something like that happens, you don't want to take that chance. So you have no option but to think here, this is, if I lose this premium, it's only a small amount of money that I lose, right? So I'll just buy this and, have peace of mind. And if I go to a hospital, if the other thing happens, it's a lot of money. So I'll get a lot of money in case something happens. I lose only a little bit of premium in case nothing happens. So you know what? I'll just buy this. This is what is going on in the heads of option seller and option buyer. Option buyer is afraid that it's all something big might happen and it's only a small amount I will lose. Option seller is thinking here, what are the odds? And even if I do, and it's not one person, I'm doing it with hundreds of people. So option buyer is basically, option seller rather, is looking for a small profit and he makes money most of the times. He is betting on a low probability event, that is you going to hospital, and he is profitable over the long run. So over hundreds of thousands of insurance policies, over hundreds of thousands of over months and months of insurance selling, LIC is largely profitable, or some other company is profitable. I don't know if LIC is profitable, but let's say SBI Life or Max New York or somebody is profitable. But here's the catch. If something happens, the cost is high, but they are able to take that risk and say, you know what, let me just. So the most important thing is high cost, small profit, and low probability and profitability over the long run. Now let's look at option buyer. Very high profit. Your hospital bills, if they are very high, you'll get so much money. You have to pay to the hospital, of course, but you'll make profit from the insurance. You make money very rarely, right? Because what are the odds that you'll actually end up exercising a policy? Most of us have policies which we have never used. The funny part is, of course, half the diseases which we get, they'll not even reimburse you for that disease. The chance of you getting hospitalized is very low. But here's the problem, right? In the long run, you will just end up paying this premium every year to LIC. Nothing will happen. And at the age of 60, 70 or 85, whatever it is, we'll happily go up. And that's how life ends, right? So it is loss making in the long run, unless of course you get a ticket early on in life, right? But here's the catch, right? Although it is loss making in the long run, the loss is fairly low if nothing happens. So this is what drives option buyer to buy options. This is what makes option seller to sell options. This is the psychology, right? So having understood the psychology of it, now let us jump into the first concept, which is a call option. So here is the important point. Forget about call option as the right to buy option at some strike or something and all that. Let's simplify the entire thing. In call option, if a stock goes up, the price of option goes up and the buyer of the option makes money. Forget right to obligation and obligation to right and selling and buying and all that. I don't know, understand anything. If stock goes up, option price goes up and buyer of the option makes a lot of money. So this is option seller like LIC and this is you. So if a huge move happens, if the price goes up, you make money. That is the only thing you need to understand about call option at this stage. And I'm going to jump straight away into an example, no theory. Let's look at SBI 300 call option. What SBI 300 call option means is, if SBI is above 300, for each rupee above 300, the buyer of the option makes 1 rupee. Right? That's it. So SBI, if it goes above 300, for each rupee above 300, buyer makes 1 rupee. This 300 number is called the strike price. It's not important. It's just a word. You can call it Mongolia or something, but it's called strike price in financial terminology, right? So what happens in this option? If it is below 300, right, the option does not come into play, right? And there is no gain, no loss, nothing. The option just becomes pointless. But it is above 300, the option buyer makes money, just like insurance, right? If it becomes above a number, if something happens, the option seller loses, option buyer gains. If it's at 302, you make the buyer gains 2, the seller loses 2. 303, buyer makes 3, seller loses 4, and so on and so forth. And if it goes to 360, big move, buyer makes a lot of money, seller loses a lot of money. Just like hospital bill, big move, LIC loses money, you gain money. So, but here's the catch, right? This is basically an insurance contract which is between SBI 300 strike call option buyer and seller. So if you go to somebody and asks, ki boss, I want this option from you, the seller is also not like an idiot, right? He'll say, ki, yeah, I am selling you an insurance just like LIC is selling you an insurance. Because you can see that there is this huge move and there's a lot of money involved in a huge move. So huge move, lot of money, similar to insurance. So the option seller says, I am selling you insurance, you have to pay me a premium for that. So just like insurance premium, option price is also called premium because it is a sort of insurance itself, right? So you pay money to the seller. So seller takes money upfront from you for option selling, exactly like LIC takes money upfront from you. One second. Sorry. Yeah. So this is actually the price of protection the option buyer pays the seller, and this is paid in the beginning, just like insurance premium. So let's just look at one scenario. So let's say SBI goes to 300. You will make 60 rupees profit, which is 360 minus 300, because we said 1 rupee above 300, you make 1 rupee, right? So, but then you paid the premium 10 in advance, so your net profit is 60 minus 10, which is 50 rupees. So this is an expiry scenario. So on expiry day, which is the day when option contracts end. So expiry is the day till the validity of option contract. On that day, if there is any movement, or before that day, or till that day, or on that day the expiry happens at 360, you make 50 rupees. And let's say in this case I am the option seller, so I will lose 60 rupees, but then you may gave me a premium of 10 rupees, so net my total loss is 50 rupees, right? I lost 50, you made 50. This is zero sum. Whatever you make, I lose. Whatever I lose, you make. Now let us look at profit and loss in some other scenarios. So at 250, I make the premium of 10 because I am the seller. You gave me money of 10. You make 0 rupee. I make 0 rupees from the option because the option is not useful below 300. So it's a call option. Below the strike price, it has no meaning at all. It just expires at 0. So this is 0, but I make a premium of 10. So total 10. You make nothing from the option and lose the premium. So it is minus 10. At 290, same thing. Below 300, it's just the premium exchange. I make 10, you lose 10. At 300 also, it's the same thing. Premium exchange. I make 10, you lose 10. At 310, there is this difference which comes in. So you make 310 minus 300, which is 10. 1 rupee for every rupee above 300. But you lose the premium, so net 0. In my case, it's the reverse. Again, at 320, you can see 20 minus 10. At 400, you can see 90 minus 10. So this is how the thing plays out. One thing you can notice here is, as a buyer, you have a lot of profits happening, but your loss is always 10 rupees, exactly like insurance, right? It's not like you have to pay LIC a lot of money in case you don't go to a hospital. The transaction is always one way. LIC has to pay you a lot of money, you only pay the premium. So option seller has limited profits and unlimited loss, just like LIC. So what is this break even thing? So a lot of people talk about options break even. So what is this thing anyway? Break even is the point at which you make neither a profit nor a loss. And this basically means you recover the premium you paid. So let's say SBI call is worth 300 call is worth 10 rupees. You make money. You recover when you recover the premium, right? The 10 rupees you paid, you have to get back. So basically it is 300 plus 10. And this is called break-even point. So strike price is the 300 number. 300 plus premium is called break-even. So it's nothing complicated. Forget about this equation and all. You have paid a premium, you have to recover it. To get back that premium, the stock has to go above the strike by that many points. So if you paid 310 rupee premium, you need 310. You paid 20 rupee premium, 320. That's the break-even, right? Very simple concept. So this is where I want to introduce to you a very important concept called probability of profit, or in other words, probability of making money. See, look at these scenarios, right? So I am taking 1, 2, 3, 4. 4 scenarios below 300 and 4 scenarios above 400, all equidistant. So look at it this way. This is the sellers and buyers P&L. At 280, again, the option is pointless above below 300. So at 280, nothing happens, it's just the premium going to the seller. 285, same story. 290, same story. 295, same story. 300, also same story. Even at 305, although the seller loses 5 rupees, but the premium of 10 rupees compensates for that, so he is still profit making, right? At 310 is when the break even happens. So if you look at the scenarios, 1 2 3 4 5 6, 6 out of 9 times the seller wins, 2 out of 9 times the buyer wins, and one scenario is a tie. So I can say that most of the times the seller wins, and you can understand why. Because the seller gets the premium, and as long as his premium is preserved, he wins, whereas the buyer has to recover the premium, which is very tricky. For that you need like a 3% move in case of SBI, because this is 310, so 10 rupees is 3% roughly. So most of the time the seller wins. Just like insurance contracts, most of the times nothing happens, and sometimes the buyer wins and he gets like a large compensation or the large option premium, right? Option premium meaning option payoff. So this kind of tells you why the probability of a seller making money is more than that of a buyer making money. And this is very important to remember, right? Although the seller doesn't make much money, he consistently makes small amount of money all the time, and that is the whole meta of selling. Right? So armed with this knowledge, let's look at when to buy and when to sell. So when do you buy a call option? You think the stock price will go up, but it's not enough that it goes up. It has to go up more than 310, right? So it has to be a big move. Even if it is slightly up, you won't make money. You can see it here, right? At 305, as a buyer, you did not make money because the premium ate up your profit. So you can buy a call if stock will go up a lot, and this a lot is important. So how much is this lot? It is more than break even. And when do you sell call option? You think the stock price will not go up, and if the price doesn't rise, you will always make money, right? So even if it rises a little bit, right? Even if the stock price will rise up a little bit or stay right where it is, or even if it goes up a tiniest bit, you can sell the call option. So basically, buy option is when it goes up a lot. Sell option is when it does not go up a lot. What does not go up a lot mean? Does not go up, goes down, stays neutral, even goes up a little bit. So basically a lot more scenarios, right? So let's put it this way, right? In case you are not sure what to do, it's always a sell. Actually, if you're not sure what to do, you should not be trading, but you get the drift. Now let us look at put options, right? Again, we have come to LIC and U example again. In put option, if a stock goes down, the option price goes up and the buyer of the option makes money. So what is a put option? It's an option you buy when you think market is about to go down. And when you buy this option and market goes down, the price of the option which you bought will go up and the buyer makes money in this case. So you make money by buying something, and then uska value increases when the stock goes down, and then you make money. So again, let's take the example of SBI 300 put. So if SBI is below 300, for each rupee below 300, sorry, this is not above 300, this is below 300. Option buyer makes 1 rupee. So let's look at this. So above 300, it does not matter, right? You can see all these above 300s are just null and void. Below 300, the option buyer makes 1 rupee. At 298, he makes 2 rupees. At 260, he makes 40 rupees. So again, this is purely from the option. Now let us bring premium into the picture. So again, the seller says that, yeah, dekho, this is insurance. You have to pay me a premium for that, 10 rupees. Again, the 10 rupees goes to the seller. And price of this is the protection. This is paid in the beginning, all of that. So let's look at one scenario. SBI goes to 260. You will make 40 from the option. And you paid the premium of 10 rupees. So your total profit is 40 minus 10, which is 30 rupees. And I, who is the option seller, will lose 40. I get the premium of 10 rupees and my total loss is 30 rupees, correct? Let's look at some more scenarios. Above 300, this option has no meaning. It is just the premium exchange. So 10 rupees the seller makes, the 10 rupees the buyer loses. But at 290, which is below 300, there's 10 rupees coming from the option for a buyer, but the buyer has to lose the premium which he paid. So net it is 0. The reverse happens to the seller. Now again at 280, the buyer makes 20, loses 10 premium. The seller loses 20, makes 10 premium. So that is plus 10 and minus 10 right here. And finally at 200, the buyer makes 100, loses 10 rupee premium, which is 90. And the seller loses 100 and makes 10 rupees, which is 90, which is a loss of 90, right? Now, again, the option buyer here of the put option has unlimited profits and limited loss. The option seller has limited profit, which is just the premium. So it's exactly like that, right? LIC makes only the premium from you. Option seller also makes only the premium from the buyer. Now let us look at the concept of break even. So break even happens when you make neither a profit nor a loss. Basically, you recover the premium you paid. So if SBI call 300 is worth 10 rupees, when SBI is at 300 minus 10, which is 290, you make the money, which is you recover the premium. So when do you recover the premium? When the stock price goes below the strike price by the amount of premium. So basically, strike price minus premium then becomes the break even for a put option. Right? So call option, it was strike plus premium. Put option, it is strike minus premium. Simple. Nothing complex there. Right? So just like call option, seller wins most of the time again. So let's quickly look at when to buy and sell put options. So you buy the put option if you think the stock price will go down. Even if it goes up, you need not make money because of the premium angle, correct? Because you have to recover the premium, right? So you can buy the put if stock will go down a lot. And if you sell the put option if you think the price will not go down, and if price doesn't fall, you will always make money. So even if the put goes down a little bit or goes down a little bit or goes up a little bit, right? So let's say you think the stock will go up a tiny bit or go down a tiny bit, you can still sell the put option, right? So that is when you buy and sell the put option. So call option not go up, put option not go down for a seller, right? Okay, so now let us go and see how option prices change. So a lot of people say that option prices changes with Greeks and all that. This is all like confusing nonsense. Look, very simply put, high probability options have high price because the seller asks more money to compensate for the risk he's taking. Now think of smokers insurance. Again, I am stuck on this smoking trip. I don't know why, but basically, if something is likely to happen, right? If something is very probably going to happen, then that option will be worth a lot of money. It's simple as that. So if somebody is old, their premium will be high. If somebody smokes, their premium will be high. If somebody is a reckless drunk driver, their premium will be high, etc., etc., etc. Right? Whereas low probability options have low price. So if there is a person who wakes up at 5 o'clock in the morning, brushes his teeth, does yoga, does not do reckless driving, does not drink, gamble, smoke, etc., etc., his premium will be very low. So you have to look at options exactly in that way. So every time an option is likely to make a lot of money, the premium will be very high. So let us now break this question to when do options likely to become likely to make money, right? So what are the factors which affect this probability or likelihood? Of course, stock price, right? Because stock price is connected to everything. Then there is strike price, which is that 300 number which we saw. Then there is time to expiry. How far away is this option from the end of options? We'll explain that. Don't worry about it now. And we'll talk about implied volatility. What? I don't know what that is. Nobody knows what implied volatility is. So let's not go deep into implied volatility. We'll just keep it at the surface and be happy. Because this is a basic webinar, right? Let's not go so deep into crazy stuff. So let's look at stock price. So for this, we'll look at one application which we developed called option price calculator. It's a very simple application. So let's see how it goes. So I'm going to look at a call option and put option both. For that, let me take Nifty. Where is Nifty right now? Nifty is at 11,828. Okay, interesting. So let us look at 11,850, which is ATM. This is some random stuff. Let's not worry about this. So this is a small feature which helps you predict the price of an option, right? So you can see, so this expected price is the price of the option, and let's see how it works. So this is expiry. The premium of this option, you can see call and put. So let me make it both buy, right? So it's very simple. So I'm going to increase the price of the future now, or price of the price of Nifty. It's the same thing. So when you can see that as it goes up, the profit goes up, correct? So this is a call option. The call option buyer makes more and more and more money when Nifty goes up. And you can see put option buyer loses only 5,000 if Nifty goes up. So premium, concept of premium. So this is a buyer of a call making a lot of money when market goes up. This is the buyer of a put making a lot of money when market goes down. So you can see that when the option price, when the stock price goes up, call buyer makes a lot of money, put buyer loses a little bit of money, and when it goes down, call buyer loses a little bit of money and put buyer makes a lot of money. So this is from a point of view of a buyer, right? We can also do it from the seller. I mean, you can go experiment it yourself. I can quickly show you this also. So a call buyer loses, a call seller loses a lot of money when it goes up, and a put seller makes a little bit of money. Similarly, when it goes down, call seller makes a little bit of money, put seller loses a lot of money. So in any case, sellers have large losses and small profits, buyers have small profits and buyers have large profits and small losses. But the important point is you can see how option price changes with stock price, correct? So when the stock price is high, call option will make money, so the probability of making money increases, therefore it goes up the price of the option. You can see the price of the option here also is changing along with your profit and loss number. Similarly, when the stock goes down, the probability of making money from put option increases. When probability increases, the option price is also very high. So as simple as that. So that's our demo. Now let us look at the concept of strike price, and let's take call option. Okay, so a lot of people have a little bit of difficulty figuring out which call is expensive, upar wala call ya niche wala call. It's very simple. Think of which one is more probable to make money, and whatever is the high probability of making money, it will cost more money. So I'm putting 4 strikes here: 290, 300, 310, 400, right? Which has the highest probability of making money? Of course 290, because it's the lowest. Because SBI is right now at what? 300. 290 is already making money. 300 is slightly away. 310 is even more away. 400 is very far away. So far away option have hardly, I mean, what are the chances that SBI will go to 400 soon, right? Very low. It has never gone there. So far away options are very low probability. Therefore, the cost is low. So you can see this one is worth 20, this one is worth 10, this one is worth 5, and the far away option is worth hardly anything, right? Far away. So this is called out of the money. It is very far away. The strike which is above the current price, therefore it won't make any money. Now let's look at put. 310, 300, 290, 200. 310 is already making money, so it's worth something. 300 might make money, it's worth a little less. 200 is very far away. There's very low chance that it will make any money, because for you to make money on a put option, right, it has to go down, and it is very far away, this 200 number. It's like 33% away. So the chances are very low. So the price will also be very low. Now that we have covered the option price and the strike price, so there's a quick example for this. Let's just verify this on an option chain, right? Look at an option chain. This is what is called option chain. So you can see the option prices here. So this is call option prices. The bottom options are worth a lot of money. The top options is cheaper and cheaper and cheaper, low probability, correct? And this is put options. Low price options are worth very less amount of money because of low probability. The above options are worth a lot because they have already made money and high probability, correct? So that is stock price and strike price. Now let us go to the next thing, which is time to expiry. So my question to you is, which one is worth more, a long-term option or a short-term option? So again, let's not think theory, let's just think of insurance, right? If you're taking insurance at the age of 20, so 65 is the age limit for insurance, right? If you start insurance early when you're 20, you have to pay premium for 45 years. It's a lot of money. Uh, Whereas if you start insurance late, say at the age of 63, you only have to pay for 2 years. It's less money. Of course, the premium amount is different. That's a different concept. But an insurance contract which covers you for 45 years, you will pay a lot more money than an insurance contract which covers you for 2 years. So long term options are worth more than short term options. You can see that also. Let's look at that, right? This is 11,850 February. It's worth what? 44 rupees. Now let's look at 11,800 of March. It's sorry, this is not there. So let's look at 11,900. 11,900 is worth 26 rupees and 100 rupees call and put, whereas in March it is worth 200 rupees. So basically a long term option cover gives you protection for a longer term, therefore it is worth more money. Simple as that. So long term options cost more. It is the same for call and put. It doesn't matter, right? Because it gives you more protection for a higher time. It doesn't matter whether it's a call or put. Both of them are more expensive if it is a longer term option. Now this is the point where I want to introduce to you what is called time value decay, and this is one of the most important concepts in option trading. So the thing is, if you buy an option, with every day which passes you lose some money as an option buyer. So let me just illustrate that here. So same situation, let's look at this option in which I was having that nifty 11,800, that thing, right? Yeah. So this is where the option is. You can see that I have, so let me just reset it to 0. Yeah, so this is almost 0, 11,825. Right. So now let us see, this is the price of the option 41 and 66. Let us see what happens to the price of the option when days pass. So you can see that 1,000 rupees has gone from both the options when 1 day passed. When 2 days passed, 2,000 rupees has gone. So between 4th February and 5th February, it loses 1,000 rupees. Between 5th February and 6th February, it loses almost 2,000 rupees. Correct? So, or now let's make another example. Let's take the 27th February option. So again, the 27th February option, between 4th and 5th February, it loses like what? Let's make both of them by. It loses like 300 rupees, right? Whereas towards the end of the expiry, it loses like 1,000, 2,000 rupees in a single day. Correct? So I can say that options lose value with each day, like you can see in this slider, 1 day pass. So basically it also means that you shouldn't buy options and keep them with you till expiry, because every day you keep them with you, you'll lose money. So this is an option losing money with every day. So long story short, you should not buy options and keep them with you, because with each passing day you will lose money. Correct? And towards the end of expiry, towards the last few days of options, they lose a lot of money rapidly. So how do you again understand it from a point of view of insurance? So that theta decay, right? It is the cost of holding option for 1 day. So look at it this way. When you are younger and when you start insurance contracts early on, right? Your insurance premium is very low per year. Whereas if you go towards the end of expiry, which is older people nearing 60 and all, then you start doing this insurance premium, right? If you start insurance at an older age, then the premium will be very high. So think about time value decay as the cost of holding option for a day or your insurance premium for a year. As you get older and older, insurance premium will increase. Similarly, as you go near the expiry, your option premium will increase. That said, let's look at the last concept, which is IV. Okay, IV is the least understood concept in option trading. Trust me, I know very few people who exactly understand what IV is. But let's put it this way. When IV is more, option price is more. When IV is less, option price is less. So that's the important concept to understand. High IV, high option price. Low IV, low option price. Correct? Let's take the example again. So this is our option. Let's try playing with this thing. So when I increase IV, you can see that option price is increasing. When I decrease IV, you can see that option price is decreasing. Correct? So high IV, both call and put, option price increases. Low IV, both call and put, option price decreases. Correct? So IV is basically a measure of risk. When there are lots of things about to happen, there is going to be high IV and high option price. So look at it this way, right? Again, like we said before, high risk and high probability options cost more money. In other words, events increase risk. So this is similar to an accident prone driver or a smoker for insurance. And high premium of smokers is caused by high IV. So think about it this way, right? Let's say I am 35 years old, right? And my friend is 35 years old. I smoke, my friend doesn't smoke. Both of us are taking option till 65 years of age. We are both of the same starting age, same ending age, I mean, physically we are same. The term of the option is also the same. So why the difference? That difference is caused by IV, right? This IV is what causes the difference in price. So for example, right, if you looked at budget day, the option prices were a lot. Why? Because somebody who is selling the option, they'll think, yeah, I can lose a lot of money if something happens. It is similar to LIC saying, boss, if you smoke, your hospital bill can become a lot and I'll lose a lot of money. So if you want me to insure you, you have to give me more premium. Similarly, when budget day or something like that comes, an option seller says, boss, there is a high probability that I'll lose money because I don't know what is going to happen in budget. It can go up, it can go down, it can go anywhere. So you have to give me more premium. So when premium increases, that increase in premium happens because IV increases. It's just important that you understand that when events happen, IV increases and option price increases. Forget the mathematics of that. If mathematics made money, you never mind, right? So basically high IV equal to high option price. Same for call and put. We just saw that in the video, right? So armed with this knowledge, let's just have a quick recap of whatever has happened through the feature which we developed. So what happens when stock price increases? Call options make money, put options lose money, right? What happens when days to expiry increases? Put options and call options both lose money with each passing day. How about IV? Both call option and put option loses money when IV increases. Both of them make money when both of them make money when IV increases. Both of them lose money when IV decreases. So these are the three key variables of option trading, and this is how this works. Now obviously the problem is it's very difficult for you to understand. I get that last 30 minutes we have been listening to this, and hopefully you've understood quite a bit about options trading and whether to buy call or sell put, etc. But here's the problem, right? It's not very obvious to you at any point, should I be buying a call or selling a put? And trust me, right, you shouldn't be wondering about all of that. Your time is better spent in figuring out is the market going up or down, and not in figuring out should I be buying call or put, what's the premium, etc. So to help you figure this out, we made a free feature. So I'll just quickly demonstrate one free feature to make life easy. This is easy options. Easy options tell you, it's extremely simple. It tells you what to do if you have a view on the market. So you could have a view like market is up or market is down or something like that, right? So easy options is the easy way to figure out what is the best option to trade if market is up, down, etc. Correct? So let's just try and experiment it. Let's say you are on this page and you're wondering here, I think market is going up. I don't know whether I should do call or put or whatever. So look, we'll tell you this way. Forget about everything. You don't have to know if it should be a call or put or something. Just say up, down or neutral, and we'll give you an option strategy which is combining calls, puts, etc. Like we mix everything and we give you an option which has two legs to it, and say that look, this is your max profit, this is your max loss, and this is what you have to trade. So you can see, for example, here that I said ki yaar, I think Nifty will go down by Thursday, and I get two options. And I think okay, I think I like this one. This has small loss, this has small profit. I only lose 3,000 no matter what happens to the market, and I can say ki I want to trade this. So this is a very easy way to trade options. I can trade Bank Nifty also. I can say ki option will go up. Sorry, the Bank Nifty will go up. I can say it will go down. I can say it will stay neutral. I can say anything. That's one part. The second part is one more feature I can quickly introduce is there's something called strategies wizard. So let's say you are a beginner and you don't again know which is the best option to buy. So I can say ki I think Nifty is below 11,800 on expiry day. What should I do? So if you have a view like this, we'll tell you what is the best option to buy or sell. So you can see that this call spread will make money, this put will make money. So this is a strategy called call spread. We haven't covered it in this webinar. We'll probably cover it at a later time. But it's important for, so let's just do simple strategy, right? You can see this is the best put, this is the second best put, this is the third best put. So this engine basically takes care of all the maths for you, so that you can just say ki, dude, I think it is going up or down, that's it. Or if you even have a bullish view, let's say 12,000, not that I think it will go to 12,000, you can see that 850 call is the best to buy, then it is 900 call, then there is 27th February call. So there's also expiry, right? So it takes care of all that math and tells you what is the best option to buy. All right, thanks so much for joining us, guys. Good luck with trading today. Have a good one. Bye.